Good morning, traders and investors. My name is Roger Scott, and I'm the senior strategist for Wealth Press. Today is Wednesday. It's September 28th. The month is almost over, and I think this bleeding is coming to an end. The market looks like it's getting ready to reverse. Now, as you can see here, the Dow's down only about 45 points. The tech-heavy NASDAQ is down about 90, and the Russell's actually kind of flat. And I've been talking about this for quite some time now. When I say quite some time, the last few sessions. If you look at the Russell 2000, this is pretty important. Now, remember what I always say, small caps tend to lead towards the end of a bear run and into a new bull market. Look at where the Russell is right here. It's right near this past support level which we hit earlier in the summer, right in June. Look at the Dow Jones. Notice that? Big difference. So you could see smaller stocks are clearly doing better than large cap stocks. Now, if you look at the QQQ, you will see that we are actually also right below that level, or about to break that level, or slightly to break that level. And even right now, in the morning, the pre-market were down 1.17%, but look at the Russell 2000, right? Look at this, down only 0.27. Big difference. There's no question that it didn't even hit this line here. So the small caps are holding on better, and it's not just here. It's also, if you look at the performance levels, and I've been pointing this out, you've got 3% of stocks above the 50-day moving average in the S&P index. You've got 11% of stocks trading above the 200-day moving average, with historic lows. I mean, real lows. But look at the Russell 2000, 9% and 16%. Versus 3% and 11%. And if you look at the QQQ, or even the Dow, look at that, 9%. Let's see here, 6%, 16%, 8%, 16%, 3%, 9%. I don't care how you dice it, slice it, or chop it. The small caps are leading. And the fact that the small caps are leading is a very positive sign. Also, I want to point out to your attention, in case you're interested in which small caps are leading, I wanted to show you that as well. I've been kind of looking at this, and I find this very interesting. If you look at the Russell 2000, which is the smaller stocks, you will see very clearly, look at this, bio, pharma, therapeutics, hospitality, therapeutics, pharmaceuticals, healthcare, therapeutics, look at this, pharmaceuticals, therapeutics, pharmaceuticals. Another one, pharma. Are you starting to get the message here, or do I need to spell it out for you? Are you guys seeing which stocks in the small caps are leading? So not only are the smaller stocks leading, but the biotechs within the small caps are leading right now. That's pretty standard, and that makes a lot of sense because they're smaller companies, they're more speculative, but remember, biotechs are starting to become more medical companies, and they don't have a lot of interest rate fluctuation because they're medical stocks. They're going to get support by the government no matter what. So let's talk a little bit about global economy, and I'll give you a full update. But again, the fact that small caps are starting to lead in this really nasty market is a very strong sign. I still think we need to have a nice shakeout, which we haven't had. We haven't had a capitulation, but it would be nice to see one. So there's a possible recession. That's what Wall Street's talking about. That's the headline. U.S. futures oil prices declined again as Chinese yen weakened sharply. And that's one of the reasons why U.S. stocks have been going down the last few days. Not because of U.S. economy, because of global economy. Very different situation. China's yen fell to a 14-year low against the U.S. dollar Wednesday, despite central bank's effort to stem the slide after U.S. interest rate hike prompted traders to convert more money into dollars. It's not a sustainable practice, folks. The U.S. dollar is really overinflated. It needs to cool off. And one of the reasons for that is because U.S. government has had positive interest rate flow compared to other governments. Small companies held up better than the broader market. The Russell added 0.4%. Again, I'm just pointing out that's a very strong sign. Remember, the Russell started going down and started weakening almost a year, like 10, 11 months before the broad market. Major market remained in an extended slump on fears that higher rates are being used to fight inflation can knock us into a recession. The S&P's down roughly 8% in September, double what it usually is in September. and has been in a bear market since June, and it now has reached those levels again when it has fallen more than 20% from its all-time high in January 4th. The Russell made an all-time high a long time before that. The Dow's drop on Monday put it in the same company. It's all in a bear market. Central banks around the world have been raising rates to make borrowing more expensive and cool the hottest inflation, but what it's been doing in the last couple of weeks has been sagging the U.S. government. The Federal Reserve has been very aggressive, raising rates. Now it's at the 3.25 rates. They're talking about 4.4%, 4.5% at the end of the year. And Wall Street is worried that the Fed will hit brakes too hard on already very, very vulnerable economy and puts us in a very, very bad position. And that's going to weigh a lot more on tech companies, which are not attractive because of higher rates. One of the catalysts that we could help get us out of this is earnings that are starting to come out in October. Government will release on Thursday this report right here, the GDP report. This is the big report. It's coming out tomorrow. That's the biggest report for the quarter, and we'll talk about it more today, but we're looking at -6, possibly -7 to 0.5. I like how it's tight. I'm hoping to see this number higher, and I'm hoping to see personal consumption expenditures above the lowest ratio. I'm hoping to see this at 1.7, 1.8, because it would tell us that consumers are spending more money, which is always a positive sign. Put to call ratio is still very much in a danger zone. Folks, we need a real rally to come off of these levels, the 136 levels. This is historic highs that we had on beginning of this week. And this tells me that the market is grossly oversold. Volatility looks like it's peaking right around the previous levels right here. So I'm expecting a rally. The question is, how much of a rally are we going to get? But again, with the put-to-call ratio being this high, I think we're going to see some significance. One of the things that I'm not happy about is the fact that the bond market is going down. But as soon as the bond market turns, and I think we're very, very close to a turn, we're going to see price come back within this range, and that'll stabilize the U.S. stocks just a bit, or at least enough to get us through this. But I think earnings are going to be the next big catalyst. I think small caps and earnings are going to be the next big catalyst to get us through this. Now, momentum levels, I want to show you the number of stocks trading above $2, right? I want to show you how momentum levels are looking right now on the overall stock market. This is the overall stock market. Look at this. This is COVID. This is 2008. We're below those levels right now. How about 200-day moving average? And again, this is the broad market. So when I say we're really low right now, we're really stretched out. This is not a time to liquidate positions that have time if you have options. I mean, look at this. We need a little capitulation. That's what we need, a little capitulation to take us down, to make it feel like the market's just falling apart and crashing, and then we're going to start coming back up again. Now, let's look at individual sectors. If you look at my filters, you will see we don't have much of a change. We still have a lot of defensiveness. Utilities, healthcare, consumer staples. These sectors are out of whack. Consumer discretionary, technology, they're out of whack. But in terms of picking the best stock right now, I'm gonna be honest with you. Let's go to the S&P. My suggestion for you is, let me just organize this the right way. My suggestion for you is to find stocks that are pulling away from all-time highs, like Albemarle. This looks really good right now. Lamb Western looks really good right now. Cardinal Health looks really good right now. General Mills looks really good right now. I would be focused on stocks that are pulling away from all-time highs. Twitter actually looks pretty good right now, believe it or not. But I would be very cautious, and I would be finding the best stocks. MCK is looking pretty good right now. Find stocks. The best stocks are right here. And if you want a good pullback, Albemarle. I'm telling you right now, Albemarle. I like it at these levels. It's at near-term support. It's a pricey option, but I think it's going to go and head higher as soon as we get some relief from this market. But I do like Albemarle at these levels to the upside. To the downside, oh boy. To the downside, let me show you what I'm interested in right now. All of these stocks are really, really, really low right now. So quite honestly, I'm not recommending anything to the downside except maybe for this Generac holding. I want to see some stocks that are moving a little bit above. Freeport may come down a little bit more, but the bottom line is that it's very hard for me right now to recommend stocks that are to the downside because the market is so darn oversold. So honestly, I would be very cautious on downside right now. If anything, you may want to buy a put in VIX, $VIX. I think that's probably going to give you the best bang for the buck because I just don't see volatility going much higher. So I think if you buy a put at these levels, you would do yourself a pretty good favor. Also, I want to show you something else. Remember the number of stocks making 20-day highs, 20-day lows? Well, that number is starting to cool off. So look at this, 17,426. Look at this number yesterday, 770. Look at this number the day before, 759, 666, 556. There we go. We're back to September 20th, where we were right before this last breakdown. So this number is, in fact, declining. And that's telling me that momentum levels are actually starting to cool off. And that means we may see markets heading higher before they're heading lower. Now, folks, we've hit historic levels this week. I mean, historic levels. I mean, put to call ratio, right? You saw the put to call ratio. I showed it to you. We hit a high of, let's see here, 126, I think. 133. I mean, look at that. All-time highs. Number of stocks trading below the 200-day moving average. Look at this. I mean, we're in the worst level. I mean, let me show you this. We're at the worst level since 2008. Look at the NASDAQ right here. This number of stocks trading below the 200-day moving average. Look at that. Lower or right at a 2008 levels. I mean, you can't make this up if you tried. And yesterday, the S&P 500 hit lows we haven't seen since 2020. Russell didn't, by the way. All my indicators are pointing to one thing. That's why I'm hosting a live briefing today at 1 p.m. Eastern Time, September 28th. It's happening today. Don't miss out. Folks, I'm hosting a live briefing at 1 p.m. Eastern Time to discuss what that means for you, what this market means for you. You do not want to miss out. Bookmark it. It's happening at 1 p.m. Eastern Time. I'll talk to you guys later. Bye, guys. Take care.